Hey, we're back with another lesson in really hard accounting, and today I mean it. I don't know many professional accountants that have this stuff memorized. Today we're talking about how to account for changes in our ownership interest in other companies. For 99% of all the companies out there, the stuff in this lesson will have little or no applicability. However, there's a handful of companies where grappling with these sorts of accounting issues can make your head spin. Believe me, I know. I was CFO and now I'm a corporate director of one of those sorts of companies. The stuff in this lesson had applicability almost every quarter for the sorts of business activities we were undertaking. Changes in parent companies' ownership can come as a result of a variety of actions, and we will focus in this lesson on the most obvious, and that being the purchase of additional shares in the investee. We will refer to these additional purchases of shares as blocks. But bear in mind, our ownership stake could also change as a result of, say, the subsidiary buying back its shares or issuing new shares. We'll cover this in another lesson. Let's look at this schematic for a moment. What I want to discuss is how we account for our investment as we purchase incremental blocks rather than all at once, which is what we've been discussing in the lessons up to this point. Think of this as a creeping takeover, which, by the way, has regulatory restrictions. For instance, in Canada, there's a general rule that prohibits a company from purchasing more than 20% of another public company without launching a takeover bid. In fact, an investor is required to issue press releases on changes in their ownership positions once they attain more than 10% of an investee's stock. So always keep in mind that there are more than just the accounting rules to think about when you look at this issue. The taxing authorities have their own sets of rules. So, let's get back to the schematic. Starting at the left, we identify a desirable investment and we take a toehold position. And at this point, it's a non-strategic asset because we have no ability to influence the decisions of management. The classification would be fair value through profit or loss or available for sale. Above 20% ownership or with other circumstances we have previously discussed, we are in a better position to exert influence, at which point the accounting method must change to the equity method. Keep in mind we are moving away from what is probably a fair value method to a largely historical cost-based method of accounting, and this will necessarily bring up transition adjustments for us to consider. In the fourth step, we are adding to our significant influence position, and the issue here is what do we do with the remaining purchase price differential from the third step acquisition? In the fifth step, we go above 50% ownership, or we satisfy one of those other conditions that indicate that we have control, which now means we need to consolidate the results of the investee company with our own. As you will recall from previous lessons, the difference between the equity method and consolidation is that we are transitioning from a one-line consolidation of the equity method to replace that with a full-blown line-by-line combination of the subsidiary and the addition of non-controlling interest. However, we will also need to deal with how we calculate the purchase price differential. And finally, in the sixth step, we are now adding to our control position. And once again, we need to consider how this is dealt with. If we are already controlling the subsidiary, how can we have another business combination? The answer is simply we can't. So once again, the accounting looks unlike the accounting in any of the previous 5 steps. The only good news is with all these steps is that the accounting is applied prospectively. That is, there's no need to go back and restate any numbers. Does that make you feel any better? Our first step is pretty straightforward. Under IAS 39, you have the choice of classifying an investment as fair value through profit or loss or available for sale. Under IFRS 9, the choice gets eliminated and you account for the investment as fair value through profit and loss. The investment account reflects the amount spent to acquire the first block and is subsequently adjusted for any changes in fair value. Note that under IAS 39, where there's not a market value information, it is permitted to use the cost method. This will be important to note when we get to step 3. Step 2 works exactly the same as step 1. So, not so bad so far, huh? Sounds pretty much like our first lesson. In step 3, things begin getting interesting. The first item we need to deal with is coming up with determining the amount to capitalize to the investment account. The answer to this question is the purchase cost of our latest block purchase plus the carrying value of our previous block purchases. Now, with our previously fair valued FVTPL and AFS blocks, this will represent the same valuation as our most recent purchase. So proportionally speaking, it won't have an impact on the purchase price discrepancy calculation. However, if we were using the cost method, this would have a difference as the existing carrying value of the investment account, i.e. at cost, would not be adjusted for a fair value increment. And before we move on to our purchase price differential calculation, note that with an available for sale classification that the amount previously reported in other comprehensive income remains there. They don't get flushed through the income statement until either we dispose of the investment or we attain control. And we'll see this again in step 5. Now, to do the acquisition differential calculation, we compare what we were deemed to have paid for our stake in the investee relative to the book value of the net assets of the investee. The difference is allocated to the assets and liabilities that have fair values different than the book value, with any remainder representing goodwill. The equity accounting then gets applied as we've discussed in our first lesson, which I will not repeat here so as to not dilute the points I'm trying to make. It's complicated enough. These fair value increments will then be amortized or reverse through the equity income as we've previously discussed, so that the investor's equity pickup reflects its rate of return on investment, which is something different than the rate of return that the investee reports to the original shareholders. Step 4 only has one real wrinkle to it. We add the Step 4 block purchase amount to the investment account, which then leads us to the question of what do we do with the existing balance and the associated unamortized acquisition differential remaining. The answer is nothing. Our Step 3 block purchase, which includes Steps 1 and 2, carry on as a separate block. The Step 4 block is separately accounted for with its own acquisition differential, which may be different than Step 3. This may seem odd conceptually, but keep in mind we are now working under a historical cost framework, so there's no adjustment for fair value. And then arrives the fateful day when we acquire the all-important block that puts us over the top. We now have control of the company, by votes or whatever means so determined. Now, gaining control is a big deal, and consistent with the entity theory, it's like a rebirth of the company. A new era begins. The first matter at hand is determining what we do with the blocks of shares we've purchased in Steps 1 to 4. These blocks obviously have an integral role to play in allowing us to attain control. So for that reason, we include them in our purchase cost. But at what amount? Now, because this is the beginning of a new era, the accounting standards dictate that we must adjust the Steps 1 to 4 blocks to fair value as of the date of the acquisition of the Step 5 block. Any gains or losses are reported through income. And as for those trapped other comprehensive income, gain and losses from available for sale investments in Steps 1 and 2, those too can now get flushed through the income statement. As such, all the shares we own have the same value basis as at the date of acquisition. We now go ahead and calculate our purchase price differential, allocate our purchase price to the fair value increments, and determine goodwill. 100% of the assets and liabilities get picked up by the consolidated entity, necessitating the establishment of a non-controlling interest to represent the ownership interest not held by the parent. From here, the rest of the story is the same as we have painstakingly learned in prior lessons. But there comes a day when we have an opportunity to acquire yet another block of shares, increasing our ownership position further in the subsidiary. However, our Step 6 block purchase is different than Step 5. Once we have control, we can't get it again. In fact, this sort of transition is characterized as an equity transaction between owners. That is, between the parent corporation and the non-controlling interest. Said another way, it's not another new beginning, but rather a continuation of the new beginning that was established in Step 5. What happens in an equity transaction like this is that a portion of the non-controlling interest account is transferred from the non-controlling interest to the parent. So first we need to know how much the non-controlling interest account has in it at the date of acquisition. This can be determined by calculating the non-controlling interest portion of the subsidiary's equity account and the unamortized purchase price differential, and determining on a proportional basis how much needs to be transferred over to the parent's account. This amount is compared against the amount that the parent purchased for the block of shares from the non-controlling interest, and it's entirely possible that there's going to be a difference. Because this is an equity transaction, the difference does not get capitalized, nor does it get flushed through the income statement. Instead, it goes as a direct charge to the retained earnings. The consolidation process carries on as it has on a go-forward basis. Only the parent and the non-controlling interest now use their different ownership percentages to determine the amount of the income and dividend allocations. By the way, the same process, only in reverse, is used when we sell a block of shares to the non-controlling interest. Here, we still retain control. The parent transfers a portion of its investment account to the non-controlling interest. Once again, the difference between the proceeds received and the amount transferred to the non-controlling interest gets recorded in the parent's equity. Another mind-boggling situation is when the subsidiary issues and dilutes the parent's ownership position. Once again, this is treated as an equity transaction. The parent gains from its new ownership entitlement to the capital raised, but it loses a proportion of its investment account to the dilution. The difference is a charge to or against the parent's equity, as this is an equity transaction and not an income transaction. The gain from the new capital is calculated as the proceeds received from the new non-controlling interest shareholders times the parent's new and now lower ownership entitlement. The loss requires us to update our investment account to the date of issuance. In shorthand, this can be calculated by adding the subsidiary's equity, excluding the new capital, plus the unamortized purchase price differential and multiplying that by the parent's ownership entitlement prior to the issuance. Then we can calculate the dilution suffered by the parent as a percentage of their lost entitlement. Now, before we close this rather complicated lesson, let's just try and deal with a couple of other variations. First, for practical matters, where a company undertakes a series of small purchases to acquire a block of shares, these can be grouped for accounting purposes. So, for instance, if the company purchased a 0.5% of the shares in week 1, 1% in week 2, 0.75% in week 3, and 0.25% of the outstanding shares in week 4, we can group all of this series of small purchases together as one block purchase. It's more of a practical approach to dealing with this issue. And don't you think for a second that accounting balances everything to the last penny. Sometimes being approximately correct is a hell of a lot cheaper and close enough for reporting purposes. Secondly, when the subsidiary purchases its own shares, the parent's ownership stake will necessarily increase. This too is accounted for as an equity transaction and mechanically works the same way as our step 6 example whereby the parent acquired those shares. Now I'm going to spare you the details in this lesson. And finally, those equity transactions with the non-controlling interest would show up within the financing section of the consolidated cash flow statement. Why is that? Well, because cash is leaving the consolidated bubble. So with that said, how are you feeling about all this stuff? Again, I debated with whether to bog you down with a detailed example, which I may do separately anyway, but I decided against it, because for most of you, you'll probably only see these types of situations a couple of times in your career, if at all. So with that in mind, my objective for this lesson is for you to be able to, number 1, recognize when you have this sort of situation, 2, understand conceptually how to approach it, and 3, point you in the direction of more resources, which you will find, as always, at theFinanceLearningAcademy.com. So until next time, don't stop till you get to the top. When you get to the top, don't stop.